Senate Bill 2155, legislation we're going to be voting on later today. This legislation is long overdue. Let me be very clear about this. The financial crisis that we experienced is a decade behind us now. The Dodd-Frank Financial Services Regulatory Bill, massive construct that wildly overregulates financial services. That was signed into law 8 years ago, and we have done nothing really meaningful to roll that back over these last 8 years. This bill is the result of years of bipartisan work, untold number of hearings, an extraordinary amount of testimony, and now we have a product that we're going to, I hope, pass later today and begin to roll back some of this excessive regulation. I would thank all the Republican and Democrat members who have worked to get this bipartisan product to where we are today. Senator Shelby, when he was chairman of the Banking Committee, laid much of the groundwork for this. Chairman Hensarling, the House chairman of the House Financial Services Committee, has done great work in this space. Of course, Chairman Crapo, as chairman, has really done an outstanding job. So we're at a point where we're very close to finally making some progress on this overregulation. I will disclose up front, I have my own personal experience and bias in this space, having worked with a great group of men and women in eastern Pennsylvania and western New Jersey. We launched a community bank back in 2005, and it was an amazing experience, a great experience. It was a very successful bank. But back in 2005, when we launched, I was shocked to learn how heavily regulated a small, tiny, startup, brand new community bank was. It seemed to me we needed permission from the regulators to change the color of the drapes in the lobby of the bank. And this is all before Dodd-Frank was passed. Dodd-Frank came along several years later and made things much worse. Way over prescriptive, way too much discretion and power in the hands of regulators, a terrible trickle-down effect whereby extensive regulations that were meant purportedly to constrain large financial institutions, in fact, also imposed huge costs on small banks. We've gotten to the point where arguably small banks are now too small to succeed. 30 years ago, we had 14,000 banks in America. Today, we have fewer than 5,000. Now, the trend toward consolidation in banking was underway before Dodd-Frank, but Dodd-Frank dramatically worsened it. One data point, I think, makes it really clear. Before the financial crisis, before Dodd-Frank came along, we used to routinely launch, on average, over 100 banks per year across America. It's a very ordinary thing for a group of business folks to come together and decide they were going to launch a bank to serve their community. And it's a great thing when people do that because it introduces new competition, new choices for consumers, new access to capital. Over 100 per year, routinely, for decades. From the time that Dodd-Frank was passed through this year, we've had 5 new banks start up in America. We've just completely destroyed the entire de novo banking industry, and there's a price to that. There's a price to communities, there's a higher cost of credit, there's less available capital, and this doesn't serve anyone well. So our legislation, this bill that we're going to vote on later today, is going to improve the overall regulatory environment. At the same time, it's going to make improvements for consumers. Let me touch on a few of the features. One is designed to improve access to mortgage credit. Section 101 of the bill provides regulatory relief for financial institutions if they originate a mortgage and keep that mortgage on their portfolio. You see, when a financial institution originates a mortgage and sells it, which is a very common practice, there's this sense that the financial institution doesn't care about the borrower's ability to repay. It happens not to be true, but there are very extensive regulations that are very onerous, and they make it more difficult for borrowers to meet the criteria that's acceptable. Well, if the bank is keeping the loan on its own books, then it should be obvious to everyone that the bank has every incentive to make sure that the loan is made to someone who can repay it. And so this section provides some relief, some more flexibility so that the bank can actually make a loan that works for that consumer rather than one that works for whatever bureaucrats have decided. Section 107 allows relief from some of the regulations in the manufactured housing space. It's based on legislation that I introduced with Senator Donnelly. This will help consumers who are using manufactured housing, which is one of the most affordable ways of having a home. There are consumer protections like Section 301, which protects consumers' credit by giving consumers greater control over their credit reports. There's Section 302, which protects veterans' credit by helping to prevent medical debt from improperly harming a veteran's credit report. There is help for community banks, the very small banks that are not systemically important even to their neighborhood, much less our entire economy. They're wildly overregulated. This at least diminishes that burden modestly. It simplifies, for instance, their capital requirements. Section 202 exempts very small community banks from the Volcker rule. Why, might you ask, do we need to exempt them from it? Not so that they can engage in the proprietary trading or the kind of investments that the Volcker rule precludes, but because it recognizes that community banks don't do that anyway. They've never done this. They end up instead having to spend a whole lot of money proving that they don't do that which they've never done. It doesn't make any sense. And so this legislation relieves them of some of that burden. Section 210 will allow, again, very small banks to have a little bit more time between the very onerous exams that they are subject to periodically. It's still very onerous, but at least there's some relief here. There's a change in how we treat bank holding companies. We have, unfortunately, as a result of Dodd-Frank, this concept of too big to fail. We have enshrined it in law by creating what we call SIFIs, or systemically important financial institutions. These are like officially designated too big to fail, and frankly, no institution should be too big to fail. But it happens under Dodd-Frank automatically when a bank hits $50 billion, and that's a ridiculously low threshold. So this legislation takes that automatic SIFI designation up to $250 billion. Frankly, it shouldn't be automatic based on the size of the institution. It should be driven by the conduct of the institution, the kind of business they do, but at least we are raising the threshold from $50 to $250 billion. By the way, this is problematic, actually, for banks that are a little larger than $250 billion. They still have this onerous, complex, expensive regime that they have to comply with when their competitors, who might be just a few $1 billion smaller, are relieved of this burden. So there's an unfairness in this. I intend to work with regulators to basically have this SIFI designation reflect the activity of the institution rather than just the size. There's another provision, Mr. President. Section 402 deals with the supplementary leverage ratio. It goes by the acronym SLR. The SLR is basically a minimum capital ratio. It takes a look at the entire balance sheet of a bank and says, well, regardless of what those assets consist of, we're going to have a minimum capital requirement. That, of course, is in addition to all the specific capital requirements that are associated with the various category of assets. That whole regulatory regime remains in place, so we have both simultaneously. This legislation has a very, very narrow exception for this secondary SLR capital requirement. It simply holds that for those handful, there's really only three, custody banks, banks that have as their principal activity the custody of securities for other financial institutions. When they take custody-related cash and they put it on deposit with the Fed or another central bank, that is a risk-free transaction. There is no risk to an American bank having a dollar-denominated deposit with the Fed. And therefore, this legislation recognizes that you should not have to be hit with an additional capital requirement for such a transaction. That is a constructive feature. Some have mischaracterized this and suggested that, oh my goodness, we could have deposits with the Turkish central bank or the Greek central bank. That is clearly factually wrong. The criteria for eligibility is very, very narrow, and it is only at the most secure central banks in the world, and by the way, mostly it's the Fed. A quick additional word about this too big to fail doctrine. You know, I feel very strongly that no institution should be too big to fail. No institution should get a taxpayer bailout. Some of my colleagues seem to agree with that. They've come down here and they've been very critical of the idea of a bailout that might occur for a financial institution. I would suggest that the best way to avoid taxpayers having to bail out a financial institution is not to attempt to prescribe every conceivable activity through massive regulation, but rather have a bankruptcy code that allows the failure to be resolved in bankruptcy. The people that should be wiped out in the event of the failure of a financial institution are the shareholders and unsecured creditors, not taxpayers. So for those of my colleagues who have come down here and expressed great concern about potential bailouts, join me in my legislation, which adds a chapter to the bankruptcy code so that we can successfully resolve even a very large and complex financial institution where we should, which is in bankruptcy, and not pose a risk to American taxpayers. Senator Cornyn and I have the legislation that will do that. It really, over time, can completely end the debacle of too big to fail, and that would be a very constructive development as well. So, Mr. President, let me conclude by saying that this bill, 2155, S2155, which is called the Economic Growth, Regulatory Relief, and Consumer Protection Act, is very aptly named. That is, the goals expressed in the title are actually achieved in this legislation. I am confident we will make progress on all of these fronts if and when, and I think we will, pass this legislation later today. So I certainly urge my colleagues to support this, but my last plea is that this not be the last word on financial regulatory reform. This is a constructive step in the right direction, but it is a modest step forward. Much more needs to be done if we're going to have a safe but robust, competitive financial system that is capable of fueling the economic growth that our economy is capable of. And with that, Mr. President, I yield the floor.